Hi, I'm Cynthia Cox, and this is the Nonprofit Minute. In previous videos, we've discussed the new FASB rules for nonprofit organizations that mainly affect your reporting requirements. Today I want to talk about that new reporting requirement that deals with liquidity and how you as a nonprofit organization have to include that in your financial statements. Let's get rid of the accounting jargon. Liquidity is about cash. The new requirements want you to tell the public how you plan to pay for your expenses next year. Where's the money coming from? Is it out of your bank account? Is it out of your investment account? Do you have receivables that you're expecting to collect on? Do you have something you're planning to sell? Do you have fees that you're going to get from services that you provide to the public? Those are the kinds of things that you have to show by number in your financial statements, specifically your footnotes, how you plan to pay for the expenses next year. I want to be very specific, very detailed here. Of course, I am a CPA. I like details. You have to give the numbers and how you're going to pay for next year based on what you have as of the end of your year. So you have to have that money in the bank. It's not money you hope to get because everybody loves you and they're going to give you lots of contributions next year. So again, those are numbers. That's a financial plan that you describe in your footnotes. The other thing that you have to do is you have to have a policy. Adopt a formal policy that describes how you keep your assets, what type of liquidity requirements you have. We have so much in assets that would cover 3 months of expenses. Those are in liquid assets. And then we have another 3 months of expenses in investments that we can get to. That would be your formal plan of liquidity. And of course, you know, what nonprofit doesn't want to have at least 6 months in cash and investments that would pay for next year? That's not necessarily where most of my clients live. But we have to explain that to the readers of the financial statements. Frankly, it's really a good policy to be able to tell people how we're going to fund next year. I'm going to give you an example of a footnote. Nonprofit A has $395,000 of financial assets available within 1 year of the balance sheet, consisting of cash of $75,000, contributions receivable of $20,000, and short-term investments of $300,000. None of the financial assets are subject to donor or other contractual restrictions that make them unavailable for general expenditure within 1 year of the balance sheet date. This footnote goes on, but you can see that it's telling you numbers and it's telling you what's available. So let me recap some of the meat of what this requirement consists of. You've got to identify your financial assets. You've got to determine the footnote, the format that you're going to discuss the financial assets in. I gave you an example of a footnote. And you've got to describe the availability of the financial assets, donor restrictions, any kind of contractual restrictions. You've got to make the reader aware of those things. So I'm beginning to get back into accountingese again, and my apologies. Again, liquidity equals cash. How are you going to pay for next year? Quantitative-wise, and what's your policy about it? I hope you're not too terribly confused and you know that you can come to us and ask your questions. We really want to help. I'm Cynthia Cox with Cox & Associates, CPAs, LLC, and we look forward to serving you.